and welcome to the screencast for the balance sheet. This screencast is going to guide you through the basic steps of creating a balance sheet. For complete and detailed instructions, you can refer to section 2.2 of your Accounting 1 textbook. We're going to start by looking at a blank balance sheet. A balance sheet is a financial statement, and with any financial statement, you need to begin by writing out the heading. The heading is always going to be the first 3 lines of the page, and it's always going to discuss who, what, and when. Who is the company or business that you're writing the financial statement for? In this case, Easy Rentals. What is the name of the financial statement? In this case, a balance sheet. And when is the time period of the financial statement? Remember that a balance sheet shows the financial position of an organization at a specific point in time. In other words, it shows the assets, liabilities, and owner's equity of a company at a specific point in time. And in this case, that point in time is September 30th. Once we've finished writing out our heading, we can begin to fill in the rest of the balance sheet. And we're going to start with assets on the left side of the sheet. So we have our assets subheading, and we've listed our assets here. You'll notice that we've italicized and underlined the word assets to show that it's a subheading, and we've listed our assets in order of liquidity. Liquidity being how quickly an asset gets converted to cash or how quickly an asset gets used up. So cash is always going to be at the top of the assets list because it doesn't need to be converted to cash, it is cash. Accounts receivable comes next. Remember that accounts receivable is money that people or organizations owe to the company. So we have 2 people that owe money to Easy Rentals here. And generally, accounts receivable are payable within 30 days. So in other words, these amounts of money are going to be converted to cash for Easy Rentals within 30 days once these people pay money to the company. Supplies comes next. Supplies are things that a business uses up over the course of a year. A good example are office supplies, so things like pens, pencils, and paper. Below that, we have land, buildings, and rental equipment, and these function a little bit differently than the other assets that we've discussed. Cash, accounts receivable, and supplies are all examples of current assets. In other words, they're going to be used up or converted to cash over the course of a year. But you don't convert land, buildings, or equipment to cash, or you don't use them up over the course of a year. So these are longer lasting assets or long-term assets. The general rule of thumb for listing long-term assets on the balance sheet is to put them after current assets and to list them in terms of how long you expect they will last. So we expect that land will last longer than buildings, which will last longer than rental equipment. You might also have heard of the term property, plant, and equipment, which is another term for long-term assets. Property is another word for land, plant is another word for a building, and equipment is equipment. Once we finish with our assets, we can move to the right side of the page to start filling in our liabilities. So you'll see the same thing here. We have a liabilities subheading, and liabilities are listed in the order that they are due. So accounts payable are similar to accounts receivable, but instead of money that Easy Rentals is expected to collect, this is money that Easy Rentals has to pay. In other words, they need to pay money to Aero Supply and Best Repairs. And like accounts receivable, generally these payments need to be made within 30 days. Bank loan and mortgage payable are longer-term liabilities that may not even be payable for more than a year. One thing to note is that you may sometimes see bank loan at the top of a liabilities list, and that's because bank loans are sometimes payable on demand. In other words, at any point in time, a bank can ask for that bank loan to be paid back to them. However, in practice, banks rarely do this, so it does make sense, in most cases, to put accounts payable first. After that, we need to add a subheading total for liabilities. Any subheading with more than one item in it must be totaled. And we total the liabilities subheading with a ruled line above the total. The reason why we didn't add a subheading total for assets is because it's the only thing that appears on the left side of the balance sheet. So we will be able to total it up with the column total, which we'll see in just a second. Once we've listed our liabilities, we need to list our owner's equity. And there's just a single account here, the capital account. We don't need a subheading total here because there's only a single account in owner's equity. So that's it. We've listed our assets, liabilities, and equity, and now it's time to do the column totals. So on the left side, we've calculated total assets, and on the right side, total liabilities and owner's equity. These totals should be listed on the same line of the balance sheet, and just like the total liabilities, we need to include a ruled line above the totals. We also, for the column totals, need to put 2 ruled lines below each total, which signifies that it is the column total. After that, we just have one more step. We need to add dollar signs to our balance sheet. Dollar signs get added to the first number in each column, in this case cash on the left and arrow supply on the right, and they have to be added to any of the total values, so total liabilities, total assets, and total liabilities and equity. And that's it. That's everything you need to create a balance sheet. Thanks for listening.